The greatest battle of a profitable trader is not fought against the market, but against the 5 inches between the ears. Good evening. We are here to talk about the market's most efficient capital destroyer, the force that turns perfectly sound strategy into reckless speculation. Fomo, the fear of missing out. If you have been seriously trading for longer than 1 week, you know the feeling. The moment the rational mind steps aside and the primal urge takes over. You've done your fundamental analysis. You've set your technical levels. You've defined your risk-to-reward parameters. Everything is ready. And then, the price moves without you. It doesn't crawl, it surges. It doesn't hesitate, it runs. And in that split second, all discipline collapses. The internal voice, that whisper of doubt and greed, screams, "Get in now! This move is leaving you behind. You will regret this for days." And you click. You rush your execution. You jump in late, chasing a candle that has already burned its brightest fuel. Within minutes, the momentum fades, the market stalls, and the inevitable reversal begins, leaving you stranded, underwater, nursing a loss born not of a broken strategy, but of a broken mind. This is not a failure of research. This is not bad luck. This is the predictable outcome of a powerful psychological assault we call the costly cognitive virus. The anatomy of the virus. The fear of missing out in trading is fundamentally an identity crisis. It is your identity as a profitable, patient operator being hijacked by your identity as a frantic, scarcity-driven consumer. We must understand the dual forces that fuel this infection, because you cannot defeat an enemy whose structure you do not know. Force number 1, the primacy of scarcity. The human brain is hardwired for scarcity. Thousands of years ago, if you saw a rapidly disappearing resource, perhaps a herd of animals or a patch of berries, the impulse to act immediately was a matter of survival. This instinct is still alive, and the rapidly rising price on your screen is interpreted by your ancient amygdala as a rapidly disappearing resource. The chart is not just a visualization of supply and demand, it is a visualization of vanishing opportunity. The logical brain knows the market is infinite, that there will be thousands of opportunities tomorrow. But the emotional brain only registers this candle right now is going away. And because you perceive it as scarce, your urgency escalates. Rational assessment ceases. Risk management is dismissed. You are no longer executing a plan. You are simply reacting to a perceived threat. The threat of being left behind. We see this most powerfully in parabolic moves, those massive green candles that seem to defy gravity. They create an illusion of easy, immediate wealth. The price action becomes a magnet for the impatient and a trap for the unprepared. You feel the market is judging you, rewarding those who are fast and punishing those who hesitate. This feeling is a lie. The market is indifferent. It is your own psychology creating the pressure. You must build a wall between the price action and your sense of self-worth. That wall is built with the bricks of strategic inertia, which we will discuss in depth in part 2. Force number 2, the pain of loss aversion. The second, and arguably more destructive force, is loss aversion. Nobel Prize-winning research in behavioral finance tells us that the pain of a loss is often 2 times greater than the pleasure of an equal gain. In the context of FOMO, this means the pain you feel from missing out on a potential profit is disproportionately larger than the joy of actually securing a similar profit. When you see a price moving up and you are not in the trade, your brain registers that unrealized profit as a psychological loss. You are not motivated by the pursuit of gains. You are motivated by the frantic avoidance of the psychological pain of regret. Let that sink in. You are not trading for profit. You are trading to stop the feeling of regret. This subtle shift in motivation is catastrophic, because when you trade from a position of avoiding pain, you violate the first rule of professional trading. Trade what you see, not what you feel. This is the cycle of the amateur. Impulse, regret, and then, often, the even more destructive act of revenge trading to compensate for the emotional wounds of the initial mistake. We call this the double dip of emotional pain. You have sacrificed not only capital, but also the trust you have in your own process. The moment you feel the impulse to trade to catch up or make up for a missed opportunity, you are operating from a place of emotional compensation, and that trade is already guaranteed to fail your long-term statistical threshold. You are not a recovery agent. You are a disciplined executor. Identifying the 5 triggers. The FOMO virus never manifests randomly. It requires a host environment, a moment of vulnerability. As professional operators, we must map these environments. We must identify the 5 most dangerous triggers that turn a rational trader into an impulse chaser. Trigger number 1, the empty screen syndrome. This is a classic. You've been sitting patiently, waiting for your A+ setup. An hour passes, then 2, then 3. The market is consolidating, doing nothing. Your discipline starts to erode. You begin to feel the need to justify your presence. You begin to feel that if you are not actively trading, you are wasting your valuable time. This pressure forces you to look for a C- setup just for the sake of action. This is the market testing your patience, and when you fail the test, the virus jumps in, whispering that any move is better than no move. Your brain mistakes activity for productivity. Remember, your profit is not generated by the frequency of your clicks, but by the quality of your conviction. Trigger number 2, the second canned collapse. You see the perfect setup. It meets 90% of your rules. You hesitate on the final 10%. Perhaps a small detail worries you, and you pass. And then, the trade takes off exactly as you predicted. The chart's success is a direct indictment of your decision-making process. The rational part of your brain says, "Good job, you stuck to your rules. Even if the outcome was profitable, the risk was still present." The FOMO virus says, "You were right, you blew it. Get in now before you lose the rest of this money." The second canned collapse turns sound discretion into desperate chasing. The move you missed validates your original analysis, but your emotion turns that validation into a catastrophic call to action. You must learn to celebrate the validation of your analysis without feeling compelled to chase the execution.
Trigger number 3, the social proof trap. You open a financial news site, or you glance at a social media feed, or you talk to a colleague who is crushing it. The confidence or the outright bragging of others acts as a direct challenge to your perceived competence. you feel the need to validate your own success by mimicking theirs. When you trade based on external validation, you are not trading your edge, you are trading their narrative. And when that trade inevitably fails, you are left with their loss and your regret. Your plan must be an isolation booth, immune to the noise of the crowd. Their success is statistical information for them, not a trading signal for you.
Trigger number 4, the unmanaged loss. You take a small, necessary loss. It hurts, but it is part of the business. An amateur handles this by immediately searching for a way to recover that money immediately. This recovery effort is almost always an impulse trade. It is driven not by opportunity, but by emotional debt. This is the genesis of revenge trading, which is the most lethal form of FOMO. You are chasing yesterday's capital instead of trading today's opportunities. Your mind is stuck in the past, trying to undo a reality that cannot be undone. The professional accepts the loss as a sunk cost and immediately moves on to the next valid setup. The greatest trade after a loss is often no trade at all. Trigger number 5, the habit of novelty. This is the subtle killer. Some traders become addicted to the thrill of a new opportunity even if they have an old, defined, profitable strategy. They see a new instrument, a new market, a new time frame, and the novelty triggers the impulse to jump in without doing the necessary foundational work. They are chasing the rush of the new high, not the reliability of consistent profit. They are trading for entertainment, not for compounding returns. If a strategy is not explicitly detailed in your written trading plan, it does not exist, period. This hard boundary protects you from the emotional lure of the unknown. The professional's view of opportunity. A professional trader does not view a move he missed as a loss. He views it as information. The amateur views a missed move as a missed chance to make money. The professional views a missed move as a confirmation of market volatility and a test of patience. Your job is not to catch every fish in the sea. Your job is to drop your line into the single defined spot where you know the biggest fish are consistently feeding. Every time you deviate, every time you chase, you are not fishing. You are merely thrashing the water. The opportunity you missed was not your opportunity. Your opportunity is defined solely by your rule set. If the move did not meet every single criterion on your checklist, it was simply noise. The discipline to see massive profit generated by noise and remain perfectly still is the hallmark of a professional operator. The fact is, the market will always tempt you. Parabolic moves will happen without you. Other traders will succeed while you wait. These are constants. The solution is not to simply try harder to be disciplined. Discipline is a finite resource. The solution is to build a structure, a protocol, and a cognitive immunity that makes it biologically impossible for the FOMO virus to trigger the buy button. The professional trader replaces the frantic need to act with the powerful, calm choice to wait. In the next section, we will begin building that immunity. We will introduce the two most powerful mental shields against FOMO: strategic inertia and the professional filter. We will learn how to make patience an active, aggressive weapon rather than a passive, defensive struggle. The edge is not found in what you know. It is found in what you refuse to do. We established in Part 1 that FOMO is not a behavioral defect, but a cognitive virus
fueled by the deadly combination of scarcity and loss aversion. We are not simply fighting a bad habit. We are fighting survival instinct. To beat an instinct, you cannot rely on willpower. Willpower is the amateur's tool. It is finite, it is fleeting, and it is guaranteed to fail when the pressure is highest. You must rely on system. The professional trader builds an immunity protocol. This protocol replaces the frantic reactive impulse with a deliberate, unshakable defensive structure. In this session, we build the two pillars of that immunity: strategic inertia and the professional filter. Pillar number 1, strategic inertia. In physics, inertia is the resistance of any physical object to any change in its state of motion. An object at rest tends to stay at rest. An object in motion tends to stay in motion. In trading psychology, strategic inertia is the active commitment to remain at rest unless a powerful, predefined force acts on you. Fomo is the impulse to change your state from waiting to acting based on external noise. Strategic inertia is your weapon against that noise. How do we build this inertia? By fundamentally reframing the act of waiting. Waiting is not passive. Waiting is not a weakness. Waiting is the single most powerful, aggressive, and profitable action you can take as a professional operator. Every moment you remain seated, unmoving while the market gyrates outside your specific setup zone, you are actively accruing 3 critical forms of capital. First, mental capital. You are conserving the finite energy of discipline. Discipline is like a battery. When you chase, you spend that energy on low probability trades. When you wait, you charge your psychological battery for the moment that truly matters, the A+ setup. Trading is a marathon, and conservation of mental energy is non-negotiable. Second, monetary capital. Every time you avoid a C-grade impulse trade, you are saving the capital that would have been lost or tied up in a statistically poor decision. Your job is to be an active conservator of capital, not a reckless spender of opportunity. Third, emotional capital. Every successful instance of resistance reinforces your self-trust. Each time you let a tempting, non-compliant move go, you teach your subconscious that patience is safe and impulse is costly. This positive feedback loop is essential for building long-term conviction. The power of the unseen profit. I want you to change your perspective immediately. This is the core belief of strategic inertia. Every time a tempting move passes without you and you successfully resist the impulse, you did not miss out. You made the profit. You made the profit of 0 loss. You made the profit of 0 stress. You made the profit of retained clarity. The profit of no trade must become more compelling than the rush of a bad trade. When you next see a stock running away from your defined entry, say this phrase out loud or write it in your journal. That opportunity does not exist for me. By choosing to wait for my setup, I am actively making a more reliable profit than any amateur chasing that price. This is strategic inertia. It is the conscious choice of calm conviction over chaotic curiosity. It is the foundational defense against the urge to participate.
The only acceptable reason to move from inertia to action is the complete, verifiable, uncompromised fulfillment of your written trading plan. Anything less is a leak of capital and confidence. Your default state is waiting. Action is the exception, not the rule. Pillar number 2, the professional filter. Amateurs trade based on possibility. What if I make 20%? Professionals trade based on probability. What is the statistical likelihood of my edge prevailing right now? The professional filter is a 3-layer psychological firewall that must be engaged before any trade order is placed. The purpose of this filter is to move your mind from the emotional, fast-twitch limbic system back to the rational, slow-twitch prefrontal cortex. This is the system that converts a reactive impulse into a deliberate, statistically weighted action. Layer number 1. The checklist consequence. You already have a checklist for entries and exits. This layer adds a mandatory psychological accounting. When FOMO hits, you must ask and answer this single question. Which specific item on my written checklist am I currently violating? And what is the statistical consequence of this violation? This is where the amateur mind is defeated. The amateur thinks, I'll just ignore the volume rule this once. The professional forces the mind to think. Ignoring the volume rule violates parameter number 7, which historically reduces my win rate from 60% to 35%, making this a statistically negative expectation trade. You are forcing your brain to calculate the opportunity cost of deviance. The emotional surge of the missed move cannot withstand the logical weight of historical statistics. The checklist is not a suggestion, it is a contractual obligation with your future profitable self. If even one item is missing, the trade is invalid and you walk away. Layer number 2, the risk accountability layer. FOMO makes you forget risk. It fills your mind only with the fantasy of profit. The professional filter makes risk your number 1 priority, forcing you to acknowledge the potential cost before the potential reward. Before clicking the order button on an impulse, you must verbally state to an empty room your maximum possible monetary loss on the trade and your maximum number of points you will allow the price to move against you before you are out. Example, I am entering this impulse trade and my maximum dollar risk is $500. I will exit if the price goes below that defined stop level. The act of clearly articulating the worst-case scenario and the exact money you are about to lose immediately reduces the impulsive appeal. The reality of the loss becomes concrete, not abstract. You replace the fantasy of profit with the reality of finite risk. This is the fastest path to clarity. If you cannot verbalize the exit plan, you cannot take the entry. If the verbalization makes you hesitate, the trade is based on impulse and must be discarded. Layer number 3, the 5-minute review. This is the ultimate circuit breaker, the final psychological defense. When the impulse to chase is at its absolute peak, you institute a mandatory, non-negotiable 5-minute cool-down period. You must physically remove your hands from the mouse and keyboard and look away from the screen. Walk away if you have to. During this time, you are not allowed to watch the running price. You can only perform 4 specific mental actions. Number 1, review your initial entry rules. Number 2, calculate the absolute worst R multiple risk to reward of the trade you are about to place since the price is already extended. Number 3, write down in 1 sentence the emotional reason you want to enter this trade. Number 4, calculate how many winning trades it would take to recover the maximum loss of this impulsive trade. In 95% of cases, after 5 minutes of forced mental separation, the impulsive energy will have dissipated. The price will either be too far gone to justify the risk, or the logical brain will have reasserted control. The emotional sentence you wrote, for example, "I feel angry I missed the move," provides the necessary self-diagnosis to prevent the trade. Strategic inertia gives you the power to wait.
The professional filter gives you the system to verify. Together, they create the powerful cognitive immunity required to stop impulse trading forever. They train your brain to recognize a non-setup not as a loss, but as a successful, profitable execution of patience.
To truly conquer FOMO, you must acknowledge that your greatest enemy is often the environment you create for yourself. The trading desk should not be a reactive environment. It must be a sterile, controlled laboratory. This requires implementing 3 tactical protocols that break the connection between external stimulus and internal impulse. Protocol number 1, the isolation booth. The moment you see a price moving aggressively outside of your defined setup zone, your natural impulse is to monitor it. This monitoring is a direct gateway for the FOMO virus. It allows your brain to engage in what-if fantasy, eroding the conviction in your existing plan. The solution is the isolation booth. The isolation booth is a complete, temporary removal of the tempting asset from your visual field. If you are watching 5 stocks and 3 of them are running without you, those 3 charts must be immediately closed, minimized, or moved to a secondary, non-monitored screen. This is not a sign of weakness. It is an act of ruthless self-preservation. You are eliminating the stimulus. Think of it like this. If you're an athlete committed to a strict diet, you do not keep junk food visible on your kitchen counter. If you are committed to your trading plan, you do not keep high-temptation, non-compliant charts visible on your trading screen. The amateur trader is hypnotized by the action. The professional understands that unnecessary information is a liability. By physically removing the running chart, you enforce strategic inertia. You are declaring that the only information relevant to your capital is the information that currently aligns with your predefined high-probability edge. Everything else is simply noise, and noise belongs off the screen. The rule? If a chart moves aggressively and does not meet at least 80% of your entry criteria within the next 60 seconds, activate the isolation booth. You will not look at that asset again for the remainder of the session. That opportunity belonged to someone else. Your focus must remain on the next valid trade. Protocol number 2, the opportunity cost reversal. In part 1, we noted that FOMO is powered by the pain of loss aversion. It makes you focus on the potential money you are losing by not being in the trade. We must reverse this psychological accounting. The opportunity cost reversal forces your brain to calculate the cost of taking the impulse trade. When the urge to chase hits, perform this rapid mental exercise. 1. Define the risk. Instantly identify the stop-loss level you would have to use for that late entry. 2. Define the target. Determine the realistic target remaining for that extended move. 3. Calculate the R multiple. Divide the remaining potential profit, target minus entry, by the potential loss, entry minus stop. In 99% of chasing trades, the R multiple will be terrible, perhaps 0.5 R or less. The risk is now equal to or greater than the reward. By forcing this immediate quantitative risk calculation, you destroy the fantasy of the endless upward move. You replace the emotion of gain with the cold, hard reality of poor risk to reward. You are training your brain to see that the impulse trade is not a missed gain, but a statistically guaranteed opportunity to lose money inefficiently. The true opportunity cost is not the money you missed. It's the high-probability A+ setup you will miss later because your capital is tied up in a statistically poor C- impulse trade. You sacrifice a high-probability future for a low-probability present. Reverse the cost.
protect the capital for the correct setup. Protocol number 3, the 24-hour rule. The most destructive impulse trades often happen after the market closes or before it opens, when the pressure of live price action is absent and the mind is free to daydream about what could have been. This is when you plan your get-even trade or your catch-the-next-big-one trade based on the previous day's regret. The 24-hour rule eliminates this completely. You are never allowed to enter a trade based on a feeling or observation made more than 24 hours in the past. If you missed a huge move on Tuesday, you are forbidden from allowing that move to influence your trade selection on Wednesday. Why? Because the market dynamics have changed, the regret has tainted your analysis, and your decision is no longer pure. You are fighting Tuesday's ghosts with Wednesday's capital. This rule enforces a strict present-tense focus. Your system must be reactive only to the current price action and current setup criteria. Yesterday's profits and yesterday's regrets are sunk costs. They are irrelevant to the probabilistic outcome of today's trade. The mastery mindset, the farmer, not the hunter. We have built the fortress. Now we install the mindset of the master. To permanently conquer FOMO, you must shift your identity from being a hunter to being a farmer. The hunter is primal. He is reactive. He chases the herd. He is driven by immediate, acute scarcity and the thrill of the kill. When the market moves, the hunter chases, expending massive amounts of energy for an uncertain reward. The hunter suffers from FOMO. The farmer is methodical. He is patient. He studies the soil, waits for the optimal season, plants meticulously, protects his crop from external threats, and waits patiently for the harvest. The farmer knows that consistent, reliable results come from process, not from panic. You must choose to be the farmer. The farmer understands that trading success is not a singular event, it is the compounding result of statistical probability applied over time. The single most powerful realization you can have is this: your income is determined by your trading process, not by the market's movement. When you focus on process, you execute your checklist perfectly, you honor your risk limits, and you maintain strategic inertia when the market doesn't align. When you focus on movement, you chase, you panic, and you succumb to FOMO. Your P&L is simply the trailing indicator of your psychological discipline. True mastery means you are bored by your trading. Boredom means you have eliminated emotional friction. Boredom means you are simply executing a profitable, proven algorithm. If you feel adrenaline, you are doing it wrong. Adrenaline is a cost, not a reward. Let the hunter chase the parabolic move. Let him feel the rush of the gamble. The farmer will remain seated, waiting for the high probability harvest that his system guarantees. The farmer knows the real profit is in the pattern, not in the price.